Hi, I'm John Tenpenny, editor of CMP Magazine, and welcome to The Big Story on Mortgage Broker News TV. When is good not good enough? Under new Code of Conduct regulations, lenders must now provide borrowers in writing all information about prepayment charges, including how the lender calculated any and all charges. What's not good enough for brokers is the fact that the new rules don't include a standardized IRD formula for all the lenders.
I do not believe so that the recent changes have gone far enough. And in here we are talking about IRD, interest rate differential, calculated penalties for fixed rate mortgages at time of exit out of them. The government done a window dressing. All they've done is put the plain language, ask financial institutions to put a plain language as to how they are calculating them. However, it is not standardized to the point where we could say that every single financial institution will calculate it using this method. So at the moment, it is still incredibly challenging to understand what a penalty truly will be at the end when the client needs to exit a fixed rate mortgage. I do believe if such a method is put into place, it would make it significantly easier to calculate the IRDs, and it would benefit our clients, and I think it would benefit our industry as a whole.
Well, I think they've made the right changes in the sense that they've made it an easier language to understand, but they definitely haven't gone far enough. Many lenders today have different methods of calculating these penalties, and if they had just come out with more of a standardized calculation, it would have been a lot easier for clients to understand.
I think the recent rule changes were a good first step. More clarification for the client is always a good thing. I don't think they went far enough in as much as the calculation itself that's used to calculate the penalty is very complicated. It's difficult enough for us as mortgage professionals to understand the calculation, let alone the general consumer.
Calculating prepayments are difficult even for brokers, let alone clients. So it's the responsibility of lenders and brokers to ensure that clients understand everything about prepayments.
First thing I'll say on that is looking at the prepayments and the penalties, that's probably the most confusion when it comes to clients. Clients have no clue what they're getting into, or rather what it takes to get out of the mortgage. So with the steps they're taking, I think it's a good start in the fact that they're saying, well, it's got to be in clearer language, but I don't know if it's far enough, because I think that what does clear language mean? Until I actually see what's been written and how it's presented, I don't know for sure whether that's the best presentation to a client. I think at the end of the day, it's the responsibility of the lender, whether it be through a broker or through a bank, to actually sit down and clearly explain, listen, if you do go to get out of this mortgage sooner, here's how your penalty is going to be calculated.
I think the fact that they've put in place a code of conduct to be able to track the kinds of information that the borrowers should have access to is a very positive thing. Whether or not they've gone far enough, perhaps they haven't in terms of being able to examine what the results of this code of conduct is. But I think the basic thing is we need more information headed to the borrowers so that they are really better equipped to make intelligent decisions. And that's our job as advisors, that's the lenders' jobs as the lenders and responsible lenders. Let's make that work for the clients in the right way and give them the information that they need. It's a very positive step forward.
The code also means that lenders must provide borrowers with an annual update on prepayment terms and possible penalties. Lenders say they welcome these new rules and will ensure that the IRD penalty calculation is easy for borrowers to understand.
Okay, I think they do go far enough, and I also think the transparency and the clarity is very important to the consumer. At Equity Financial Trust, we are going to make it very clear. So it's either a 3-month penalty, which is very easy to calculate, or an interest rate differential. We're going to use the Royal Bank posted rates as our base rate to calculate. So if there's 2 years left in the mortgage, you look at your 2-year rate with Royal Bank posted, look at the face rate of your mortgage with Equity Financial Trust, and the difference between the two will be your interest rate differential. We will also have an online calculator put on our website by November of this year, so people can work out their 3-month penalty and their interest rate differential, so they can calculate it and see whichever's higher, so they can make their financial decisions based on that.